Let's get more from Chicago. We have Jim Bianco, president of Bianco Research, joining us. And Jim, what about these European stress tests? I mean, EU banking regulators have told lenders that they're planning, maybe assuming a loss of 17% in Greek government debt and a mere 3% in Spanish bonds. Are these sometimes really realistic here?
Those numbers probably aren't realistic, but think of where we were just 24 hours ago. They were denying that they were even going to use any kind of default assumption. So we've gone from 0 and 0 to 17% on Greek bonds and 3% on Spanish bonds. So it's definitely a move in the right direction. It's a move towards a more realistic stress test. This whole decline in markets around the world has been about a fear of losses in the European banking system. And the stress tests were critical in trying to give us clarity. And now that they're moving more towards a realistic assumption, I think the markets are embracing it.
Yeah, what about the market rally that we saw on Wall Street? 3% plus gains for the S&P 500, similar gains really for the Dow Jones Industrial. Do you think investors are trying to find too many positives here coming from Europe?
It's hard to say because the market had been down so much, even though you're right, it is the largest rally we've had since May. We're only at levels that we were at a week ago, right? So it's not been a breakout in the technical sense. Investors are right to say that if the Europeans are going to do a more realistic stress test, that should be positive for the market. We were oversold, and so they took that positive and they kind of ran with it. Now, we'll have to see what happens in the next couple of days. I suspect you'll get some kind of a retrenchment as opposed to further rallies over the next few days. And if so, it looks more just like the downtrend might be intact as we move forward from here. And we'll wait till July 23rd when we get the actual results to see what they yield in the stress tests.
Now, you make a very interesting comparison, Jim, because you brought back the memory of those U.S. bank stress tests. And don't forget, when we got those results in May of last year, we had already seen the market bottom. Do you think that's also the case this time around for the European ones?
It could, because the stress tests in the U.S., even though they were picked apart and picked to death and everybody talked about what was wrong with them, they forced the banks to raise about $85 billion in capital. If these stress tests force the banks in Europe to raise money, it cushions them against any further losses, and that would be viewed as a positive. If the stress tests in Europe are viewed as something to kind of wash this whole problem away and say there's nothing wrong here, move along, there's no capital that needs to be raised, I think it would be taken as a negative. Last year, the market liked it because it forced the banks to raise capital. Hopefully, we're getting the Europeans closer to that point where they could force their banks to raise capital and dispel any fears of a crisis in the banking system. Remember, it was only 2 years ago that everybody was panicking over the banking system. So these are kind of raw wounds that we have. And whenever we bring up the idea of more banking losses, it's going to get a big reaction in markets like we've seen for the last 2 months.
Okay, so we might have seen the market bottom, but going forward, Jim, you're still advocating, I guess, a risk off, getting into these high-quality bonds, government bonds, really, and getting into gold. Yeah, before today's announcement of the change in the stress test, I'd been saying that the risk-off trade should continue to work. That would mean stocks, corporate credits would go down, gold would probably trend higher, and Treasury bonds would probably trend higher. I'd still advocate that position, although I'd say that the news here is encouraging, but one announcement is not enough to turn the trend, but it is, at least for the first time in a while, an announcement in the positive direction and not one in the negative direction. Okay, Jim, we got a minute here, but you said one announcement doesn't make it positive. So what other numbers or data are you watching out for in the next few months or so? The housing market would be the next one that I would look at beyond just the banking system. That would, if the banking system is problem 1, the housing market is problem 1A at this point. We've had a lot of stimulus going into housing. We've had the Fed buying mortgages. We've had the first-time home buyers tax credit. Those have all rolled off. And unfortunately, it looks like the housing market's going right back down to the lows. It's looking like the housing market might not have recovered at all. It was just artificially propped up from stimulus. And now that that stimulus is gone, it's kind of falling back down. If it continues to fall down and confirmed in the next few months with falling prices, that would be another big negative for the economy. So that would be the next big worry point that I would be looking at right now. Okay, Jim, thanks for your time today. Jim Bianco of Bianco Research.